Hi, I'm here with Bert Hochfeld. My name is Jonathan Hedvat. We're going to talk about, since Bert has experience in hedge funds, we're going to talk about how, recent research is that a lot of hedge funds or hedge funds overall they lag the S&P 500 or major indices. Bert happened to have beat the market very well in 2017 and 2016. Even 2008, he was the #1 hedge fund, making a profit when the average fund lost around 50 to 60%. But Bert, how are there so many hedge funds that are losing money, and what is the difference between the ones that are making money versus not? I mean, are there different... You could just tell me.
A lot of hedge funds are closet indexers, okay? They shouldn't be. They say they're not.
Closet indexers are people that are just basically matching the stock allocation of S&P 500 or the Dow or so and so?
Mm-hmm.
So,
that's exactly what you see. And hedge funds, in order to market in this day and age, have to be able to show that their monthly drawdowns are minimal. Okay?
What's a monthly drawdown?
How much they might have lost in a given month, percentage loss. Well, okay, so if that's what your mantra is, if that's what your goal is, it's almost inevitable that in a rising market you're not going to be able to match the index.
Because maybe you're very afraid to take risk.
How else are you going to avoid drawdowns, okay? I mean, if you go to a typical fund of funds or allocator, and you say, I had a drawdown of 5% twice last year, see it, okay? They don't even want to talk to you because they can't sell that product to most of their clients.
Fund to fund invest a large pool of money in different funds.
Yes.
Yeah.
I mean, if you're trying to work with those kind of people, very large institutions, pension funds, whatever, you're going to wind up having to invest the way they want you to, not the way you want to. Mm. And so it's very typical. Now, if you're Stevie Cohen and you have the track record,
or Stacy Capital,
and you have the track record that man had, okay, you can tell people go fish. I mean, you don't want to invest with me? Fine, I don't care. I mean, if I had $5 billion, I would probably feel the same way.
So, what if a hedge fund said, okay, I have 4 different types of funds, and every year a few do good, a few do bad. He could always say, hey, I got a few good ones, you should invest in that. And it sounds like it's luck, that a couple did good, a couple did good.
I mean,
does that happen?
Honestly, most hedge funds do have multiple products, yes.
And that's a way they could lure in people with the performance of the good funds.
Well, this is a very sophisticated undertaking, especially since that guy, why can't I think of him, the guy who stole all the money?
From?
The hedge fund, the guy who ran the hedge fund and stole,
Is there a name for the BP, where is his initials?
What, I think?
No.
Bernie Madoff. Bernie Madoff.
Yeah.
Sunday afternoon, my brain's half quiet. People are don't think that people are deaf, dumb, and blind. They're not, okay? Yeah. You have a hedge fund, it has a process. You have to tell people the process you have. You have to explain to people the risk you are taking and what the record is of that strategy.
Yeah.
I mean, and by the way, John, you run the hedge fund this week, you run it, because people will go away from the hedge fund if John doesn't run it.
Oh, yeah, I see.
So they have different products, yes, but you can't fool people about that. And honestly, you shouldn't try. Okay, I mean, I would say to anybody, full disclosure about everything is by far the best way you can go through life with a minimum of angst, if you will.
Okay. So, besides the funds that just don't try to track the S&P 500, do you think that a lot of them beat the market, or less than half?
Many of them, like I give you an example. There's Balyasny. I don't know if you have heard of this.
I've not heard of them.
So Balyasny is not really. Balyasny is 100 different groups of people like you and me, okay? And Balyasny supplies them with compliance, with trading, with a place to live, okay? Some marketing, that kind of stuff. People have different strategies, okay? I mean, some people are stock pickers, some people like to, and I am, okay? But there's plenty of others, for example, who only do paired trades. Okay, they're market neutral funds.
So, pair trade is like you're going long something and short something else.
Yeah.
So that you take less market risk.
What they do, they take plenty of market risk, but because they lever up. When you're market neutral, you're probably levered 10 to 1.
So you're borrowing 10 times your original capital, but you
offset that because you're long one thing and short the other.
Yeah.
So, but never think that that's low risk, because it isn't.
Yeah.
God forbid. You've told me that you've had days when your shorts went up.
Yes.
Yeah. Well, imagine how you'd feel
Your
if
shorts went up 10 times.
Yeah.
Yeah. That's not good.
So, I mean, I've dealt with those kind of people.
Can that be successful though?
Oh, sure. Oh, yeah, absolutely. I mean, for example, I think a good pair trade right now might be Oracle long, IBM short.
Is Oracle taking market share away from IBM?
I think it is.
Uh-huh.
I think it is. You know, or, I mean, I have owned in my model portfolio SAP, okay?
Yeah.
And it's not because SAP is necessarily the best stock in the world to own, but I sort of use it as a hedge in a funny way, and it's gone up a lot.
Yeah.
I mean, I think if I were running a hedge fund, of course I'd have shorts, but I mean that's what a hedge fund means, is managing risk. But in a model portfolio, that's not typically what you see. But the fact of the matter is, I think, I'm trying to remember the name of one of my largest customers was a market neutral hedge fund.
The Ocean Park?
No, Ocean Park, no. I can assure you Ocean Park, who's on the second floor of that little building that in New York we'd call a taxpayer, is not. You see, there was a staircase that I had to walk up.
Oh, wow. So
I wasn't fond of that.
No. All right. Thank you very much, Bert.